Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The stock markets wobble across the world ahead of US inflation data that's due later today. The Sensex loses over 400 points, the Nifty down over 100 points. The rupee remains on a tight leash against the dollar. Negotiations between India and the UK over a potential trade deal could extend beyond October, even as both nations were hoping to finalise an agreement by Diwali. The UK Trade Department tells CNBC-TV18 it will not sacrifice quality for speed and will only sign a deal when the interests of both nations are met. Indian startup funding hits a two-year low in September quarter amidst the global slowdown. This according to a PwC report. But early-stage funding remains upbeat, accounts for 21% of the total funding as venture capital firms continue to back the Indian startup ecosystem. The festive season brings some cheer for Motown. Passenger vehicle sales rise 92% in September. Commercial vehicle sales rise nearly 40%. Two-wheeler sales also rebound with a 13% growth, but auto dealers say entry-level cars and bikes continue to struggle. 11 airports are next in the line for privatization. A cabinet note will soon be sent. Sources in the aviation ministry say the government will not reintroduce the airfare cap and interfere with market dynamics. Go Air has also applied for the emergency credit guarantee scheme along with SpiceJet. The Supreme Court delivers a split verdict in the Karnataka hijab ban case. One judge upholds the ban, but the other calls wearing a hijab a matter of choice. The Chief Justice of India is likely to refer the matter to a larger bench. The hijab ban is likely to continue in the interim. Well, the Infosys numbers that we've been waiting for flashing on your screens. Rima Tendulkar joins us now with a first cut. Rima, the numbers out.
Thanks so much for that. And there is a big margin beat. Margins have expanded by about 150 basis points, close to that on a quarter-on-quarter basis, much higher than street expectation. The street was penciling in about a 40-50 basis points margin expansion, but at 21.5%, this is a good 100 basis points higher than street expectation. So there is a big beat coming through on the company's margin performance. In terms of the rupee revenue, well, it's largely in line with street expectations. The company has clocked in a 6% quarter-on-quarter rupee revenue growth, but due to the margin expansion, the company's, the profitability has gone up by close to about 12.3% on a quarter-on-quarter basis. Okay, this is the big news. FY23 constant currency revenue growth guidance has been raised by 100 basis points at the lower end. The new guidance stands at 15 to 16%. Earlier guidance was 14 to 16%. So they're basically tightening the guidance. At the upper end, it stays the same at 16%, but the lower end of the revenue guidance has been raised by 100 basis points. The new guidance for this year is at 15 to 16%. Two apart. One, this comes in as a big positive surprise, and it should allay street concerns. Everyone was worried about slowing demand due to the volatile macro situation. But after HCL Tech, this is Infosys, the second large IT company, which has gone ahead and raised the revenue guidance. Secondly, the fact that the revenue guidance is now tighter, which means that the company is very confident. Why do you give a large 200 basis points range, right? The earlier range was 14 to 16% because you never know how things play out. You want to leave yourself that buffer. They brought down the range to 100 basis points, which is indicative of the fact of the company's confidence and how sure they are. They don't need to leave that kind of a buffer. Okay, now let me, there is a margin guidance as well. The FY23 EBIT margin guidance has been revised to 21 to 22% versus 21 to 23%. Okay, so the margin guidance earlier was 21 to 23%. Now they're saying it will be 21 to 22%. It should not come as a surprise because last quarter, after Infy's margins missed expectations, Salil Parekh very clearly said that for the full year, our margins will be at the lower end of our range of 21 to 23%, which means street expectations were anyway close to 21.5%. So the company has tightened the margin band. So this the upper end has been brought down, but I don't think it should cause any nervousness in the street. This is exactly what we saw in the case of HCL Tech. Both HCL Tech and Infi have pretty much raised the revenue guidance, at least at the lower end, and they've tightened the margin guidance. So that is a positive. Okay, there's one more important internal that we would like to talk about, and that's the buyback. The company's buyback size is 9,300 crores at a price of 1850 rupees per share. 9,300 crores at a price of 1850 rupees per share. The stock closed at 1490, which means we are looking at an upside of nearly 30%. That's a 30% premium to where the stock closed. This will be an open market buyback. Maybe over here, the street is a bit disappointed because a lot of analysts and market men that I spoke to said that maybe this time, Infosys could do a higher buyback. Street expectations, I think IFL was at close to about 10,000, 11,000 crore rupees. So the buyback amount at 9,300 crore, maybe just a tad bit lower than market expectations, but it makes up by the premium. A 30% premium, 1850 is the maximum buyback price, and that's a good 30% premium to where the stock has closed. Let me quickly recap all the numbers that have come through from Infosys, and then we'll invite our experts to give their take on the numbers. Infosys Q1 revenues in line with expectations, slightly lower actually. It's come in at 4% versus expectations of 4.5%, but there is a big margin beat. Margins have expanded by 140 basis points on a quarter-on-quarter basis, driving a 12.5% increase in the profitability. So in Q2, there is a margin beat. The revenue guidance has effectively been upgraded. The company is now expecting revenues for FY23 to be in a range of 15 to 16% and margins to be between 21 to 22%. Buyback has been announced, an open market buyback of size 9,300 crore rupees at a maximum buyback price of 1850, which implies about a 30% premium to where the stock is closed. Sandeep Agarwal, the executive director at Nuvoma, now joins us on the show now. Sandeep, thank you very much for joining in. Your first take from Infosys, what would be the top 3 takeaways and what is going to surprise the street?
No, I think, this is a good move of, narrowing down the revenue guidance and also the margin guidance to be more realistic. Because if they would have kept the 14 to 16 range of guidance, then it would have implied a lot of uncertainty and unnecessary confusion of, upcoming. So I think they have removed relation by narrowing both the revenue growth and guidance. Good to see here is that, this is exactly what we also discussed in our review, and we are speaking in 2 days back. So this is a quarter we will see rise in numbers on the positive side for most of the companies. But a cautious because no one wants to take any right because of the uncertainties. I would say one thing that 2-3 quarters you will see commentary will be cautious. Actual deliveries will be very strong. After that, the commentary also becoming optimistic. I think right now is the time where you should buy IT stock.
Sandeep, sorry to interrupt you, but we've got you on a very scratchy line, so it's difficult to understand what you're saying. We'll reconnect with you. In the meanwhile, let me call on Moshe Khatri, Managing Director at Wedbush Securities, on the show now. Moshe, yesterday the 2 numbers that we got, created a lot of flux, right? You don't know if things are bad, as Wipro's numbers seem to be projecting, or things are good, as HCL Tech was indicating. Now we've got Infosys numbers. What have you made of it? What stands out for you? Where was the surprise?
Yeah, better than expected results. That's number one, or better than feared results. That's probably a better way of putting it. Margins better than expected. Mixed on the revenue numbers. I guess we're yet to kind of.
Go ahead. Seems like Moshe is getting our audio with a bit of a lag. So we'll try and fix that as well. In the meanwhile, we've reconnected with Sandeep. Sandeep, go ahead. You were making your point about Infi's numbers. Okay, a little bit of a technical glitch. Let me just run you through some more details that are coming through. So Infosys large deal wins are looking good. It currently stands at $2.7 billion. This is higher on a quarter-on-quarter basis. So that's point number one. The digital revenue growth. You remember Infosys, unlike TCS, classifies their business in terms of digital as well as non-digital. So the digital constant currency revenue growth on a year-on-year basis has gone up by 31%. This is significantly higher than the overall revenue growth. That's of 18% on a year-on-year basis, so the rest of the business, which some people would call legacy, has clearly slowed down quite significantly. In terms of verticals, financials has done okay. It's about 11.5% year-on-year revenue growth, but it's lower than what the company's average is. So we would like some clarity, because even TCS's BFSI growth was on the lower side. BFSI called out insurance as a vertical where they'd seen growth moderating. But in the case of Infosys, we'll find out why the growth in the current quarter is lower than the company average. High-tech has also seen growth moderating now to high single digits. But many of the high-tech clients globally have also seen a lot of furloughs as well as issues. So I guess that explains. The street was worried about the outlook from the high-tech clients. We have Moshe Khatri with us. Moshe?
Yeah.
Yes,
so
go ahead.
Good to be back.
You were telling us how the numbers are better than feared, what the markets were fearing.
Yeah. So, better than feared numbers, better than feared margins specifically. And I think we've seen that from some of their peers, that they did a bit better on margins this quarter, given the fact that maybe you have some relief on the cost side. And then finally, obviously, they raised guidance for the year. So these are kind of the three big takeaways. And as you said, I think at this point, the demand looks decent. The question is, where are we going to be a couple of quarters from now?
As I said, the deal wins are actually looking good at $2.7 billion in the current quarter. It's much higher than last quarter, which was about $1.7 billion. In Q1, the street was disappointed that the deal wins have dropped off. But this quarter, the company has clearly made up, so deal wins is a big positive. There is live footage of the Infosys press conference. It's in person. My colleague Ritu Singh is also there. On your screen, you can see Salil Parekh, who's the CEO, MD. You've got Nilanjan Roy, who is the CFO of the company. So we'll be cutting across to it. Just some more internals. I'm trying to find out what the attrition number is for the current quarter. Attrition has come in at 27.1%. which means attrition has declined on a quarter-on-quarter basis. Last quarter, attrition was at 28.4%. So attrition has come down, so that's a positive. Another number that we are looking at is trying to gauge what the hiring is. I can't calculate, but it looks like the company would have added about 10,000 people to its headcount, this time around, which is a pretty healthy run rate. This would be the average over the last 4 quarters or so. So unlike TCS as well as Wipro, where the hiring numbers were a bit muted, in the case of Infosys, the hiring number appears to be fairly strong. Let me try and tell you what Salil Parekh has to say in his press release. Strong large deal wins and steady all-round growth in Q2 reflect the deep relevance and differentiation of our digital and cloud solutions for clients as they navigate business transformation. While concerns around economic outlook persist, our demand pipeline is strong as clients remain confident in our ability to deliver the value they seek, both on growth and the efficiency of their business. This is reflected in our revised revenue guidance of 15 to 16% for the full year. Do we have Sandeep with us? Sandeep, go ahead. Tell us your take.
No, I was just saying that, this is the exactly thing which we were forecasting, that, this is the quarter where your revenue growth and margin numbers will be positively surprising, but, the commentary will be cautious. Fortunately for us, the commentary is not as cautious as we have anticipated. But next 2-3 quarters, because of furloughs and macro uncertainties, probably you will be in a similar environment where actual results will be better because of the very strong order book in the past, but the commentary will remain cautious. But I think this is, a very good time to start accumulating the stocks, because you will have a very strong FY24 in mind.
Thank you for joining in. The management is speaking. Let's cut across.
Growth at 18.8% and sequential at 4% in constant currency. Growth in Q2 was broad-based with all industries and geographies growing in double digits in constant currency. This momentum is accompanied by a strong pipeline of large deals and the highest large deal value in the last 7 quarters at $2.7 billion. 54% of this is net new. These elements are a clear reflection of the deeply differentiated digital and cloud capabilities we have developed that are highly relevant for our clients' strategic priorities. Our digital revenues are now 61.8% of our overall revenue, and they grew at 31.2% in the quarter in constant currency terms. While digital continues to see strong growth rates, we are seeing this quarter acceleration in the growth trajectory of our core services. This is due to our industry-leading automation capabilities and reflects an interest among clients towards cost optimization programs. We also see this in a large deal pipeline with strong focus on cost reduction programs in addition to the digital transformation programs in the pipeline. While we generally do not share the specific amount of our cloud revenue, we are delighted to share that in Q2, our cloud revenue was larger than $1 billion, showing tremendous strength of our cloud services, especially our industry-leading Cobalt capability. A strong growth was accompanied by operating margin expansion of 150 basis points, where we had an operating margin in the quarter of 21.5%. This stemmed from cost efficiencies, optimization in large deals, and currency benefits. Our attrition has been decreasing now for 3 quarters on a quarterly annualized basis, including now in Q2, and we see this trend along a downward trajectory. In keeping with our capital allocation policy, the board has announced a share buyback of rupees 9,300 crores and an interim dividend of approximately rupees 6,940 crores. With that, let me open it up for questions. Rishi, over to you.
Thank you, Salil. Joining Salil is Mr. Nilanjan Roy, Chief Financial Officer, Infosys. With that, we'll open up for questions. The first question is from Ritu Singh from CNBC-TV18.
Hi, Salil here. A quick question on your guidance that you've given from 15 to 16% for revenue. You've tightened it further to about 14 to 16%. The upper end remains the same, but if you could give us a sense on what made you tighten the guidance, and also on your share buyback. You had the option to go all the way up to 18,000, as we understand. Why capped at about 9,000 odd that you've done? Thank you.
So on the guidance, we've had an incredible large deals performance in this quarter, 2.7 billion. We've had strong momentum, 18.8% growth in the quarter. We continue to see good traction. We also see that there is some caution. Last time we had mentioned that we saw some caution in mortgages in financial services. We talked about retail. We now see some caution in high tech and in telecom. Keeping all of those factors, the positive factors and the global macro factors, we have decided to make our guidance narrower at the higher end of the band that we had. So it was 14 to 16, and now it's 15 to 16. On the share buyback, let me request Nilanjan to address that.
Yeah, so on the share buyback, of course, the board considers a lot of factors, but coming to your specific point on the maximum, since it's an open market offer, it's limited to 15% of the share capital and reserves, which is about 9,400 odd crores, give or take. So the board has decided a figure of 9,300.
Thank you. The next question is from Anisha Jain from ET Now, and Anisha sent her question on text. What has supported the margin performance? What are the levers to improve margins hereon? Deal win is strong at 2.7 billion. Going forward, do you expect clients to cut spends of this run rate of over 2 billion? Will that continue? Will FY24 also see double-digit growth?
So let me start with a couple of them. The margin, Nilanjan will come back on. On the deal wins, I think this is an incredible performance from the company. 2.7 billion is a very large number we have a very strong focus on large deals, and 54% being net new, that gives us a really good platform for what we see in the future. Now, large deals, we've always maintained these are volatile. Some quarters, the numbers are high, some are low. These are not a very predictable outcome. But in general, if you look over a 4-quarter period, we have a fairly good large deal momentum. Our pipeline for large deals remains quite strong today, and it's in a good position. So we feel comfortable with where we are in the market. Just to add the macro comments that I made in the earlier question, those obviously still hold.
Yeah, so on the margin, we've improved from 20.0 to 21.5 sequentially, which is 150 basis points improvement. We got 70 basis points out of that because of the currency benefits. All currencies versus the dollar, as you know, depreciated as well. And of course, there was a cross-currency impact. So that gave us 70 bips. We got 90 basis points from cost optimizations. And of course, you're aware of the levers we deploy in terms of the pyramid, in terms of automation, in terms of on-site offshore pricing. So between that, large deal optimizations and other costs which we have been able to take out, are partly offset by utilization. We got about 90 bips from there. We got about 40 bips from reducing our subcons, again, a cost lever which we've been trying to attack. That gave us 40 bips. And this was offset by about 40 bips from comp related because some of our comp hikes were rolled out in 1st July, as we mentioned. So all in all, we got 150 basis points improvement. If you see from the guidance perspective, and as we had mentioned in the last earnings call, we had said we will be at the bottom end of our 21-23 guidance. We have now looking at our first half performance. We have for this year at least tightened it to 21 to 22%, and we expect to be at the bottom end of that band.
Thank you. The next question also on text is from BQ Prime. Sajith Mangat asks, for Salil, can you elaborate on the demand environment in the US and Europe in context of the geopolitical events in Europe and macroeconomic challenges seen in the US? What is the exposure to Europe, especially Germany? And how do you see the TCV pipeline? And for Nilanjan, similar question on margins again. How do you see the trajectory for margins given weak traditional H2? And what is the kind of leverage available with respect to bench utilization?
So on the demand environment, what we see is on the macro front, what I shared earlier, which is we had indicated last time we started to see some concerns in the mortgage side, in financial services, in the retail industry. We are seeing this time some concerns on high tech and in telecom industry in addition to those. These are more on the discretionary part of our pipeline. We also at the same time seeing a strong large deals pipeline, which gives us some confidence. We've pivoted, and I think the market itself is also pivoting with the clients, where there's more and more interest in automation and cost efficiency, and we see that coming through within our pipeline. We've seen growth both in digital, over 30%, and in core, which shows that both of our engines are working quite well. In terms of US and Europe, today, in Q2, we had a very strong growth in Europe, over 30%, strong growth in the US, over 15%. We continue to see the pipeline between both of those geographies today, but also keeping in mind that we are being watchful given the macro environment developing.
Okay, that is Infosys management talking about their performance. It's overall a pretty decent quarter. On revenues, there is a bit of a miss. That's a number we didn't earlier talk about. Constant currency revenue growth in the current quarter has come in lower than expectations. So Q2 performance is mixed because revenues have missed, but on the other hand, the margin expansion of 150 basis points has taken the street by surprise. FY23 guidance has also been tighter. I would suspect on the whole, this is a positive because the lower end of the revenue guidance has been brought higher. The new guidance says the growth will be 15 to 16% versus their earlier guidance of 14 to 16%. So net-net, that's a positive. But it's not a full upgrade because the top line, the upper range of the guidance still remains the same as 16%. The deal wins is the strongest number at $2.7 billion. And the management saying that they're seeing a very strong strong large deal pipeline. So deal wins is strong. They continue to acknowledge that the macros remain challenging and therefore they're cautious. And now increasingly they are seeing concerns and maybe some slowdown in the discretionary part of high tech and telecom. These are the two new areas that Salil Parekh has outlined where you are seeing some amount of a slowdown. The buyback has also been announced, 9,300 crore of an open buyback at a price of 1,850. So all in all, it's a pretty good showing from Infosys. It's not a thumping beat the way HCL Tech was, which was a beat, an all-round beat. But here on Infosys, there was a bit of a revenue, miss. That's the only niggling worry. But on the whole, it's a good showing from Infosys this time. We'll slip into a very short break, but stay with us on the other side. Markets Today comes up.